Hi, my name is Judy Raneri, and I'm the co-portfolio manager of the Gabelli U.S. Treasury Money Market Fund. Today, I would like to discuss what we expect at this week's Fed meeting scheduled on Wednesday, December 13th. After nearly 2 years of raising the Fed funds rate to restore price stability, the Federal Reserve is poised to all but declare that campaign to be over. While the Federal Open Market Committee is likely to keep its policy statement largely unchanged, that statement will, at most certainly, be trumped by an improved outlook in the Fed's summary of economic projections. We expect that the SEP will offer a more encouraging outlook on growth, employment, and inflation, and also include a reduction in the median outlook for interest rates next year, showing a Fed funds rate to hit approximately 4.5%, down from 5.5% on the upper bound. And given the improved outlook for the economy, Chair Powell will find it very difficult not to sound dovish on the future monetary policy when he addresses reporters after the meeting. So the Fed, though, will make it clear that its efforts to restore price stability is not complete, and they will proceed carefully. After all, they are continuing to draw down its balance sheet by $95 billion a month, and it has already reduced it from $9 trillion last year to roughly $7.8 trillion today. But the Fed is approaching the point at which it will need to begin adjusting its rhetoric to prepare the markets for cuts coming up. Currently, the markets are factoring in about a 60% chance of the Federal Reserve reducing rates at its March 2024 policy meeting. And although the timing and scale of these cuts seem a little bit early to us, the rationale behind it is likely for the Fed to cut rates is becoming clearer as inflation continues to ease and the long-term impacts of past policy decisions are becoming more apparent. The recent optimism influencing asset market prices stems largely from the belief that the battle against inflation is definitely winding down. Leading indicators such as falling oil prices, ongoing disinflation in goods and services, and a slowdown in job growth all suggest that both headline and core inflation rates will continue to show a deceleration. So with the overall economic context suggesting that a less restrictive policy rate might be more appropriate, it really makes sense for the Fed to start discussing their first rate cut at this meeting. To sum up, our analysis of monetary policy suggests that the Federal Reserve is likely to lower interest rates next year, safeguarding the real economy as inflation continues to show signs of easing. This move is anticipated to facilitate a smooth and gradual economic adjustment, aiming for that soft landing. We anticipate the Fed will essentially announce the end of its current tightening cycle on Wednesday, and through its summary of economic projections indicate 2 rate cuts in the coming year. And that will be based on a more positive forecast for growth, inflation, and employment. Thank you.